We'll start now. Good morning, everyone. Thank you so much for joining us on this Saturday morning. I hope you and your loved ones are in good health and doing extremely well. In last couple of years, India has shown its potential and credibility in creating good startup ecosystem. In fact, we have seen number of startups which have become unicorn. Some of them are actually on the path of becoming unicorn. So this has created very good opportunity, investment opportunity in this space, be it at seed level, be it at private equity level, venture capital level, series A, B, C, D, and so on and so forth. However, there is a challenge for an individual investors to invest in, like which startup to invest in, how many startup they should invest in, where do you find those startups, at what valuation it makes sense to invest in that startup, is this startup scalable, what are the risks involved into it, where do I get the financial or rather any information regarding that startup, and how do I read those numbers or between the lines. All this interpretation is difficult for an individual investors. To address this challenge, last time we had introduced seed fund from Point One Capital, and most of you have already invested in. This time we have come across with very interesting product concept and in this space, and that too from Hdfc Asset Management Company. Hence we are presenting this to you as an investment opportunity. So before we start, few instructions. We'll run the presentation first. Whatever questions you have, we will take it at the end of the session. You can put those questions in the chat box. And I request each one of you to put yourself on mute. So let me welcome our speaker for today's session. He is a CA by qualification. He has over 18 years of work experience in financial service sector. He has joined Hdfc Asset Management Company in July 2004 and has worked across multiple roles, multiple locations, multiple verticals. In fact, we know him for the last 15 years. His primary role includes conceptualizing new products, initiative, fundraising, and he is an integral part of the team working on this particular product concept. So let me welcome Mr. Dilraj Singh. Over to you, Dilraj.
Thank you, Megasham. What I'll do is you've laid the ground in terms of introducing the asset class or how we are trying to simplify this journey for investors. And I'll run the presentation for about 15 odd minutes, and then we'll take you through the broader landscape of the private markets in India, and then what we are trying to put together and what is it that investors can kind of look forward to.
Perfect.
Just a moment. So, see, is the presentation visible?
Yes.
Okay, lovely. So, the private markets in India, Megasham did mention about the kind of startups which are getting set up. Over last decade or so, there have been about 57,000 startups which have got registered or launched in India. out of which about 10% have got funded. 5,050 startups have got funding from the venture capital funds. In terms of number of investors, this looks like a low number of about 9,300 investors, but this is largely the beginning. Over last 10 years, it's largely been institutional participation, or people who made money out of the startup ecosystem. Those founders have been very large angel investors within the Indian ecosystem. We feel, besides the global capital, the domestic institutional capital, all family office capital, and ultra HNI capital. Now, with more and more institutions coming into this space, the investment management coming into this space, the number of investors will only increase. And in terms of numbers, in terms of numbers or value, this ecosystem in terms of value has almost become 15% of the listed market cap. So in case the listed market cap is about $3.2 trillion, the private markets are getting valued at about $450 billion. So they are, in terms of valuation, almost 15% of the listed space. Why should you be looking at private markets when you have funds that you can invest into? You can do direct equities. There are other liquid options available. This you should be looking at as a diversification to your existing portfolio. Plus, the stage in the sectors at which these companies are available are not available in the listed space. So, in case you want to catch companies on day zero, or companies which are high growing and still unlisted, or in the private equity space, there are enough and more mid-market Indian businesses where there are succession issues, where there are family disputes, or the promoter is generally fatigued in terms of scaling up the business and would want to monetize. Those are the kind of opportunities which we can participate through VC and private equity funds. The biggest difference that we see is involvement of the manager in a company, underlying company. So in case you make a financial investment into any listed equity, or even in the unlisted space, you're buying some shares, you are just a financial investor in that company. Whereas when a venture capital and a private equity fund invest into the company, they actively engage themselves, they get into strategy, they would hire people for those underlying companies, they'll get them customers, they'll redesign capital, they'll bring down their cost of capital, they'll do a bit of governance, tightening of the books. All efforts are made towards polishing the business and to make it sale ready and take it to the next level. So that is the advantage of investing into private markets. In case we look at the listed space, the number of listed companies on NSE are about 1,700. Whereas we just saw there are about 5,000 startups which have got funded, and the universe is huge. And most of these sectors, let's break it into venture and private equity. In case you look at venture as a space, there are sectors like fintech, B2B enterprise tech, SaaS, edtech, D2C brands, agri-tech, blockchain, AI, ML. These all businesses are still innovative businesses in the young startup ecosystem. And these opportunities, in case somebody wants to participate, can only participate in case you are able to invest early. And see, overall universe looks about 5,000 companies which have got funded at the seed space. But the companies which kind of break out and go to Series A and ahead, the universe narrows down to about 20 to 30%. So we have enough and more investment managers, private equity and venture capital funds, which have got set up in India over the last 2 decades, who've done multiple vehicles. So there is a track record to judge them. There is a track record of entering and exit. There is performance data. There is underlying company data. There is data to substantiate their value add to these companies. So the method of evaluation has become stronger, and the mode of participation is becoming wider. On the private equity space, if you look at why should somebody be looking at investing into private equity, again reiterating the same point, you get to take substantial stake in the company, or you could take control of the company if it's a control or a buyout fund. You get representation on the board, you strategize on the business, digitize the business, you would work on the governance. And the biggest advantage is you get these transactions at a discount to listed peers. So in case it's a pharma company, it's a manufacturing company, it's a tech company. So these companies are early stage, high growth, unlisted, illiquid. So you get a discount to the public market. And then after spending 4-5 years, the manager kind of draws out a exit strategy. We feel over last 10 years, there are three factors, on the digitization. COVID only accelerated it. There are about 60 crore smartphone users in the country. 99% of the Indian adults own Aadhaar now. And then there are 30 crore live UPI users. And average Indian, spends almost close to 5 years per day on the smartphone or the mobile phone, which is there. And data cost is cheapest in the world. So all of these factors make it very easy for products and services which need not to set up brick and mortar presence. Mobile phone is the target audience markets, and in our sense, it's a fairly large market to address. This is to do with, let's say, the background of what has happened or what is VC&P. Let's look at few numbers. In case you look at the kind of
Dilraj,
investment which,
Dilraj,
yeah,
I think your slide is not getting rolled. Matlab, only
it's
one.
not moving.
It's not moving. Can you? I think we are just able to see only first slide.
I'll reshare it. I'll reshare it, Megasha. I'll
Yeah.
reshare it. Can you see it now?
Yeah. Now it's there.
Okay, lovely. So in case you look at period starting 2016 till about 21, the amount of investment has gone up by 5 times. So from a $16 billion in 2016, the investments last year were about 77 billion. And the number for this year is a comparable number compared to last year. And these numbers are matching, and both in terms of the value and also the number of investments, the average ticket size of investments. So whether it is number of deals, whether it is average size of the investment, whether it is number of sectors, so more and more sectors are getting participation from the VC and PE funding. In case you look at the exits, although this asset class is known to, people think there is only way in, it's very tough to kind of move out. But numbers speak otherwise. In case you look at the PE VC exits which have happened since 2016, the number is gradually inching up, and you see a steady number of about 8 to 10 billion every half year. And the last year number was about $40 billion, and number for first half of this year is close to about $10 billion, which is about 75-80,000 crores. We think in case businesses are saleable, businesses have value, you will have enough and more investors wanting to participate. And we've seen various modes of exits. We've seen open market exits. We've seen secondary transactions wherein one fund is selling it to the other. We've seen strategic sales where a larger business kind of buys out a smaller business. Then there are buybacks. In case businesses are doing well, the promoter kind of buybacks investors. And finally, the most known mode of exit is the IPO. And all of these five modes of exits have been explored. And depending upon the size and nature of the business, a suitable mode is selected. Uh, Besides the numbers, what matters from an investor's perspective is what kind of returns have been delivered or what can we expect. In case we look at period starting FY16, and there's a reason why 2016 has taken as the starting point. SEBI mandated all PE funds to make their data public, and Crystal has assigned this exercise to collate data and share it with respective fund houses. So it's only 2016 onwards data is publicly available. But so far as our diligence is concerned, we've taken data from these fund houses since inception. And we can't make this data public or publish it because we've signed NDAs with these fund houses. But in case on an investor level, somebody has specific queries, we can certainly address it on a one-on-one basis. So if we look at this data, this is the first stock chart on the left, are performance of venture capital funds. they have delivered in excess of 30 to 35% over last 6-7 years. In case we look at private equity as a space, the returns have been in the range of 20 to 25%. And the strategy that we are trying to run a strategy which is a blended strategy, which is 50 VC and 50 PE. We expect to deliver a gross return of about 25, 26%. So because ours is a blended vehicle that we are trying to put together. This is the first ever product where we are taking a group approach where three large group companies, HDFC Limited, Life and Bank are coming together. We are setting up an investment advisory board from all these three companies. There'll be three senior people. And why are we synergizing on this product? Because all three entities have been very large investors into private markets in India. They've got a captured history of these funds. They have a fair bit of reference check, live data, performance history on the underlying managers. And then basis our investment process, whatever is shortlisted will be run past the investment advisory committee. And we want to be a one-stop solution. This product will be a one-stop solution when it comes to taking an exposure to private markets. So whether there is a manager which invests at a pre-product, pre-revenue stage, or a manager which comes in a little later at proof of concept stage, or the next stage, which is product market fit and unit economics, or in the private equity space, the mid-market growth buyout funds, or late stage companies or pre-IPO companies, all of these you will be able to participate into a single fund by investing into HDFC AI. So what are we trying to put together? We are constructing a portfolio where up to 50% of the capital will be allocated to venture capital fund, and the balance will be kept for investing into private equity funds. And it will have three components to the portfolio. So there will be primary funds. We are also looking at evaluating few secondary transactions. So in case there's a large fund, large investors who's seeking an exit, the life of the product could be about 10 years, and 5 years are over, and there is a large investor who's looking for an exit. We might evaluate those transactions from a perspective of investment within the AI. So you have primary funds, you have secondary transactions, and then the third leg of the portfolio is co-investments. We are allocating a maximum of 30% of the corpus for making co-investments. These are large ticket investments which come from private equity funds. In case they are not able to absorb a large transaction completely within the portfolio, the balance transaction is showcased to large investors of theirs. And we, being an institutional investor, will get the benefit of investing, co-investing into these funds. In a total basket, we will have about 14, 15 VC and PE funds. And our focus is to kind of focus on return, risk, and liquidity in terms of portfolio construction. And we have this is a synopsis of portfolio construction, or what is the key differentiator. We have a fairly robust analytical fund selection process. We have a very detailed process on who will be our preferred partners. We will take you through portfolio construction. On the risk management, none of the funds in our portfolio will be more than 20% of the portfolio. On the underlying fund, we won't be more than 20% of the underlying fund. So if there is a scheme, we intend to collect about 2,000 crores. So not more than 400 crores can be allocated into a single scheme. Let's say we pick up a scheme and the corpus of the scheme is 1,000 crores. We wouldn't want to write a check larger than 20% of that scheme, which in this case will be about 200 crores. And you are getting effective diversification in a single basket. So you get 0-day companies in the fund till about pre-IPO. So the entire pre-listing journey of the company can be effectively diversified and captured within a single fund. Access is a very, very relevant point here. There are a lot of these underlying venture capital and private equity funds who do not accept domestic H&I capital. They only prefer institutional capital, whether it is global or domestic. And with this fund, you will be able to get access to those funds. There are a lot of funds where the minimum investment is 5 crores, 10 crores. It ranges up to 30 to 50 crores. All of those funds can be accessed by an investor just by committing a minimum of 1 crore into our fund. So far as performance reporting and analysis goes, all investors will get their tax statements, quarterly portfolio update, and 6-monthly valuation chain from a perspective of, let's say, tracking our performance. And in terms of governance standards, we would want to be the best in class. So I will just dwell on, let's say, how we run the process. We've looked at about 200 managers in the country, out of which managers who are meeting our criteria in terms of size, style, sectors, subsectors, we narrowed down the universe to about 80, 85 managers so far. And within these 80, 85 managers, we've shortlisted close to about 30 managers so far. And this exercise has been going on since December of 21. So we've come fairly a long way. We've done exhaustive work on these managers, and it's a multi-layer selection process. It starts with reaching out to a manager, having a 30 to 45-minute call in terms of manager introducing themselves, telling us about their track record, team strengths, USPs, and then they kind of share data room and other diligence material with us. Basis number crunching at our end and the diligence report that we make, in case we find the fitment of the manager within the portfolio, we would request a deep dive on-site visit. There we spend anywhere ranging from half a day to full day at the manager's office. And the idea is to completely scan documents, their IC notes, understand all layers of teams which are there. And after we come back from the manager, like I said, we are working with 3 group companies. We kind of get into our network in terms of the ref check on the manager. In case we think the manager is ticking all the boxes in terms of the quantitative scorecards and the qualitative factors that we built into, we would do due diligence by an external agency, one of the big fours. They will do a financial and integrity due diligence on the manager. Once we get a report from there, the final investment case will be presented to the investment committee before we head out. These are some of the factors that we look for in managers. The managers need to be well aligned. There has to be skin in the game. There has to be performance fee sharing with the team, because this is a very, very people driven business, wherein the team which is responsible for constructing or nurturing the portfolio, that to our mind should stay with us till the exits, because these are people who will be able to scale up, handhold companies and see companies till the exits. And they would only stay back only and only if there is an incentive for them, which in this case, most of the cases is the performance fee, which comes at the end of the fund cycle, is shared by the team. And then on the next stage, in case you look at our portfolio construct, we are looking at 3 factors. We are looking at primary, secondary, and co-investment transactions. On the risk management, I've already highlighted not more than 20% in a single fund, and we wouldn't want to be more than 20% of the underlying fund. And this is the kind of diversification that an investor gets. You get to participate into funds at all levels of the business cycle. So within the venture capital space, you will have funds which invest at pre-product, pre-revenue. There are funds which look at proof of concept, product market fit, crossover funds. And on the private equity side, we've kind of bucketed the managers basis the check size that they do per investment. So you have very large mid-market funds which write between 600 to 800 crores in a single transaction. There are niche mid-market boutique Indian firms, which in our understanding are also late-stage venture, early-stage growth kind of funds. These funds write anywhere between 200 to 400 crores in a single transaction. Then there are specialist buyout funds and control funds, wherein they completely buy out. In case it's a listed company, they'll delist, kind of polish it, improve efficiencies, and wait for unlocking and re-rating over a period of next 4 to 5 years. We've also looked at a couple of sectoral and thematic funds as part of our process. So these are access related issues. So there are funds where minimum commitment requirements are higher. There are funds which are hard to access. And then in case you are trying to build a portfolio where you want to have 12 to 14 funds, the capital requirements will be very, very high. We, being an institutional investor, will be on the investment committee of all the underlying funds. So even from the governance perspective, things are taken care of. This I've covered in terms of performance and reporting. Coming back to the gist of the presentation, why should you be looking at our AI? We think we have an advantage in terms of leveraging our network. You are able to access a lot of funds which are otherwise unaccessible or have higher commitment amounts in terms of accessing. You're getting diversification in a single basket. And most importantly, the diligence aspect, the HDFC AMC's diligence, the group diligence, and then third-party validation by one of the big fours on the underlying manager. I would like to highlight three important risks in this product. There is a risk to capital, there is a liquidity risk, and then there is commitment risk. And how do we address these risks? There is a capital risk because we are investing into young businesses. These are high growth transitory businesses that we are looking to invest in. We think diversification across stages will kind of help us mitigate this risk. This is a 11 plus 1 year product. So all our underlying funds, which we intend to make as part of our portfolio, have a life ranging from 7 to 10 years. We have an additional 1 year in our product life because we'll be kind of under committing to the underlying funds over a period of next 12 to 15 months. So we've taken an additional year in terms of portfolio construction. No matter how much you read about this asset class or what's happening in the startup ecosystem, you should be committing under committing to this product, as this is the first starting point or a first journey to the private markets. So commit as much capital that is not required for next 6 to 7 years, because the way cash flows will work is over a 5 year period we'll be drawing down the capital. From the 6th, 7th, and 8th year, you can expect your capital committed to come back. 9th, 10th, and 11th year, we expect the returns to follow. During the life cycle of the product, we intend to deliver a return of, let's say, 3 to 3.5 times of the capital committed. And in terms of XIRR, this will translate into about 18-19%, but we are targeting to get to a magical number of 20. And these are all post management fee and carry numbers in terms of performance. In terms of the product features, it's a 1500 crore plus 1500 crore. There's a green shoe option that we have. Whatever we collect from our investors, we would like to highlight. We would be committing 10% of our own capital. Our group companies are also committing. There is only a minimum investment amount of 1 crore, which will be drawn down over a period of 5 years. There's a management fee of 2.5% and a carry of 20% with full catch up. And this is inclusive of the underlying manager's fees. So two things that I would like to highlight is, one, the management fee and carry is inclusive of the underlying manager's fees. So there is no double layer fees that the underlying manager is charging a carry, then HDFC AMC is also charging a carry. Likewise, on the next sheet, taxation would be of interest for all of us. Taxation, most likely, the third line will be relevant for us because all of these are unlisted businesses. Most of the venture capital businesses are exited through either secondary transactions, strategic buyouts, M&A is what happens. And if those are the exit modes which end up happening for a company, the tax applicable will be 20% with indexation. It gets taxed as debt, but the holding period is lower of about 2 years. And private equity funds target to take companies public. So whichever companies are exited through the public market route, the tax applicable will be of the listed equity of 10% with surcharge and cess. So effectively, on a blended basis, we think the effective tax will be somewhere about 14 to 15%. I will just quickly take you through the strategy. Beksham, you can see the next slide on strategy, investment strategy.
Yes, we can.
Okay, lovely. So this is the AIF that we are trying to put together. Half of the capital goes to VC funds, the other half goes to private equity funds. I will just share the universe of funds that we've looked at across stages. So these are funds, we've broken them down and the list is still expanding. And within this, the VC space, we'll have about 7 to 9 funds. And on the private equity side, we've bucketed funds basis the check size of the investments that they do. So within this universe, we will be picking up about 4 to 5 schemes. So overall, there will be about 12 to 14 schemes in our portfolio. So this is on the strategy. Now, in case you have questions, I'll be happy to address.
Thanks, Dilraj. Thanks for wonderful presentation. I open the forum for the questions. Anybody has any questions? You can directly unmute yourself and ask the questions, or else you can type in the chat box. Dilraj, before the question comes, I want to ask you one thing. You said that you'll be spreading your investment across 12 to 15 schemes overall. Now, when we say 12 to 15 schemes, ultimately, how many companies you will be investing in? Number of companies.
So, see, on the private equity side, we'll have 4 or 5 funds. Each of these private equity fund invests anywhere between 8 to 12 companies. So, on an average, you can consider 10 companies per private equity fund. So, that will be about 50 companies. On the venture capital side, again, there are different levels of concentrations that happen. The funds which are very early in the life cycle, let's say the funds which come in pre-series A, funds that come in at the angel stage, or funds which come in at the seed stage or pre-series A, they have about 30-35 companies in the portfolio. So we'll have 1 or 2 of those funds. Then the series A funds have anywhere between 20 to 25 companies. Then series B, C and ahead, the ticket size of investment increases and the concentrations of the portfolio increases with it. So there will be about 15-20 companies. So overall, we intend to have about 150 to 200 companies in the portfolio.
Great. That's wonderful because it helps in terms of diversifying the risk, and that too at various stages of fundraise. Good.
That's
Good.
correct.
So, Megasham, I have a question to.
Yes, sir. Please go ahead.
What's the minimum investment size that is being proposed?
So minimum is 1 crore, sir. 1 crore is split over a period of 5 years. So in case you commit a 1 crore of investment into this fund, you will pay about 20 lakhs on sign up, which is 20%. 12 months from here, you will pay another 25%. 12 months from the second year, you will pay about 25%. And the balance in the fourth and the fifth year, you will pay remaining 15% of the capital committed. So 1 crore minimum investment staggered over a period of 5 years.
Okay. And then you said that it will have to run for around 11 years.
That's correct. See, although life of the product is 11 years, the average holding period on your investment is no more than 6.5 years, because you will take 5 years to deploy the capital. Sixth year
Correct.
onwards, your cash flows will start. By the time it's eighth year, your capital committed should come back, and then the balance returns will follow, sir. So on an average, the holding period on each drawdown will be about 6.5 years.
So if I understand it correctly, from the 6th year onwards, the capital starts coming back.
That's right, sir.
And it's recouped, hopefully, by the 8th year. Is that what you're saying?
That's correct, sir. That's correct.
Okay. And also one confusion for me: how different is it from the usual mutual funds that you put, apart from the ticket size that is an obvious difference?
So, it's a fairly valid question, and that's where I started from. When you have so many other liquid options available, wherein you can get money back on a T+1 basis, why should you be looking at this asset class? So, a primary difference: one, this is the unlisted space. These are businesses we cannot buy otherwise. But then, in case we are not able to buy, why is there a reason to buy these? Because these are young businesses which are high growth businesses. Are return There is a potential to earn higher returns when you come in the early life cycle of the company. The second difference, which is prominent, is all these venture capital funds and private equity funds work inside the company. They are working alongside the promoter. The promoter, in case there is a requirement, needs to maneuver their strategy, and they do a lot of value add, because most of these people have a good blended experience of operations. They've kind of run corporations, they've run businesses, they've sold businesses, and they've got into a private equity or a venture capital as a space in terms of investing. So we think one opportunity to come in early in the life cycle of the company, that gives you higher returns, and second is active investment in the unlisted space. So these are two key differentiators. Most of the sectors that are targeted in the tech and tech enabled space, wherever there is disruption happening, newer categories are getting created, or a lot of innovation is happening, it is happening in the startup ecosystem. So in case there is an intent and there is space in the portfolio, one needs to look at it. And all asset classes journey starts from a large investor, and then over a period of time it expands. And you will see the same thing happening for private markets in India. Currently, let's say till about 2015, this was purely a global or a domestic institutional market in terms of from the investor's perspective. But 2017-18 onwards, a lot of ultra HNIs have started to kind of come in. And going ahead, we think this space will only expand as more and more investment managers come into the space, sir.
Thank you, Dilraj. But if the potential is high, the risk also is equally high.
Is very high. The risk is very high, and that is why we've kind of doing a blended vehicle. So the risk is highest at earlier stage. So funds which have come in at the pre-product, pre-revenue stage, there the returns are the highest and the risk is the highest. Let's say, to give you an example, let's say in case it's a 30 company portfolio of a manager who's investing at a pre-product, pre-revenue stage, 10 companies you can expect to be completely written off. The next 10 can deliver you anywhere between zero point 0.2 to 1 time of the capital invested. The balance 10 companies, top three have the potential. Within the venture capital space, they call it a power law. The top 2, 3 companies have the potential to deliver 30, 40, 50 times the amount invested. So because of the return dispersion in this manner, you get about 4 or 5 times on the portfolio. But then there are write-offs which happen along the way. Since you've raised a point on risk, I will share a history of one of the oldest or one of the older VC funds in the country. It's called Bloom Ventures. We've been evaluating them. They've so far 4 funds. So they could today also it's a kind of a still awareness is spreading in terms of how you can participate. 2011 were very early days so far as this asset class goes. So the first fund that they did, they could only collect about 100 crores, and the startup ecosystem was just opening up. They made about 90 investments out of that 100 crores, and around 47 were written off. So the balance investment, the value of 100 crores, they exited in 2021-22 was about 670 crores. So the balance, despite a 47 write-off, your portfolio went up by about 6.7 times after expenses. So that is the kind of return which was delivered. The next vehicle that they did was a larger vehicle. They collected about 450 crores and made about 50 investments. So lesser number of investments, larger corpus, fewer bets. They just made about 50 investments, 10 got written off, 20% of the portfolio was written off. The next fund that they did was 750 crore in 2018. And there they did about 30 investments, and there is a single write-off, only one write-off that has happened. And 2022, they've collected 2,000 crores, sir, and they intend to make 15 to 20 companies. So the ecosystem is evolving. Managers have better pattern recognition capabilities in terms of the founder. The founder quality is improving. And we think funding is least of the worry. It is the quality of ideas, integrity. Those are factors which have become crucial. So there is definitely risk, but we think the learning phase of this industry, people have come a long way. So going ahead, failures will continue, but we think the ratios will continue to reduce. The failure ratios will continue to reduce.
Thank you, Dilraj. If I have anything further, I'll pass on to Meghasham. He can perhaps get clarification.
Thank you, sir. Thank you.
Thanks, sir. Thanks, sir. Any questions? Dilraj, before any question comes, I have another question. So you mentioned about returning the capital after 5 years, like 6, 7 years. So all this capital or the flow of money coming to the customer's account, will it be with tax deducted at source? How it will be, whether the client has to make sure that he files the tax on his end, or it is deducted at the fund level? How that taxation works in this particular product?
So from a taxation perspective, category 2 fund of funds are a pass-through. And it is as good as an investor making that investment directly into the underlying company from a taxation perspective. So as and when a tax event happens, there is an exit that happens, the underlying fund will receive capital, they will receive cash, they will pay that cash to HDFC FOF, we will deduct a 10% TDS. This is as good as an advance tax on behalf of the investor, and tax computation, tax liability gets paid at the client's end. So in case it's an unlisted exit, the client is liable to pay 20% with indexation. And in case it's a listed exit, 10% is the tax rate that an investor would pay. And from our side, we would be providing tax statements just the way we provide for capital gain statements in case of mutual fund investments.
Perfect, perfect. And how do one evaluate how the fund is doing? It's sort of, is there any, in normal case, in mutual funds, we know there is an NAV. How this works in this fund? You'll have an NAV.
There will be an NAV, there will be units, and the NAV will move up or down every 6 months, because all private market investments by regulation have to be valued every 6 months. On a quarterly basis, you will get a newsletter which updates you on what is happening, where have we invested, what is happening in the underlying funds, what the quarter gone by and the outlook ahead. On a 6 monthly basis, you will see valuations moving for the portfolio.
Okay. Thanks. Any further questions? I think there are no questions in the chat box also. We'll wait for a minute, or else we'll then conclude the session. I think, Dilraj, as of now, there are no questions, no further questions. We'll come back to you in case of any questions we get from the clients once we share the recording also, because some of them who couldn't join, if they have any queries, we'll get back to you.
Thank you.
Thank you so much for your presentation. Thank you so much for your times. I also would like to thank all the participants for taking out your time on this Saturday and attending this session. We'll conclude this session for now. Have a nice weekend ahead. Thank you so much. Thanks, everyone.
Thank you, everyone. Thank you.